Hey everyone, today I want to show you how to play or invest in Discovery if you don't have a lot of capital or you don't want to risk a lot of capital. Now, some of you may have seen the video I posted the other day where I valued Discovery using a DCF model and came to the conclusion that Discovery is worth anywhere from about $40 to $45 a share, which is substantially above today's prices. But if we want to give ourselves a decent, let's say 20+% margin of safety, we can reasonably say, all right, Discovery's been worth or has a maybe a near-term target of $30 a share, right? And I don't think that's crazy. I think we could actually get there in the next 2 or 3 months. If you look back at a chart, you can see. Let me see if I can pull this up. It wasn't too long ago. This is 3 months ago that we were at 27, right? Look at a 1 year chart. Back in December, January, we were above 30. So I don't think it's crazy to think that we can get back there, especially when I looked at the numbers and I concluded that really, you could make a good argument that the stock's worth 40 to 45. John Malone, the legendary media tycoon and investor of Liberty Media, he has his hands in Discovery, and interestingly, I think back in November or November, of last year, he actually bought. I can't remember. It was a big chunk, millions dollars worth of Discovery shares. I think at the $26, $27 price range, and back then I think he thought it was a steal. So I wonder what he thinks now. Anyway, so today I want to talk about two different ways that you can play Discovery. So the first way that I would play Discovery using options is just with a straight up call option. And those of you who are familiar with options know a call option gives you the right to buy 100 shares of the stock at the strike price that you choose and on or before the expiration date that you select as well. I'll show you that in a second with the options chains. And I actually did this trade earlier today, this morning, so I should have made this video yesterday or something because the stock went up promptly. I think I bought it probably, I want to say right around this time in the morning, right? And then it just took off, which doesn't typically happen that quickly. We had an 8% up day, right, which is pretty atypical. Just an aside, stock prices follow a power law distribution, right? So if you look at daily stock moves, percentage moves for a particular security, it's a power law distribution, kind of like earthquakes are, where you have a lot of instances where the stock is up probably like 1%, is maybe an average day, up or down 1%, right? And 8% only happens once in a blue moon, right, for most stocks. That's just a side note. Anyway, so I actually bought this option here that you can actually see, the 2250. So that's the strike price. 2250 October 16th expiration, that call option. And so when I bought it for $180 this morning, and the stock went up, so the value of the option went up. So went up $70, right, which is 38%, which is a nice gain. So you can see buying options like a straight up call gives you quite a bit of leverage. So let's just look at the numbers. So 38% up when the stock was up 8%. It's actually already up a couple percent when I bought it. So let's say a 6% from when I bought it. It moved 6% from when I bought it, because like right here, it's probably like 6% from there, and it was already up 2% when I bought it. So 6% move caused a 38% gain, right? So that's like more than 6 times, right? 6x the leverage, right? So 6 times 6, 36, right? So it's close. So 6 times leverage on from that call option. which is cool. So it's a nice way to leverage your funds without having to use margin or borrow money, right? And so the most you can lose is what you paid. So that $180 I paid for this option this morning, right? That's the most I can lose. The stock goes to zero, that's the most I lose. Now, if I were to tell you or teach you one thing, is to think about options as basically a substitution for stock or a replacement for stock. It's a proxy for the stock. Let me show you really quick. So if I go, it's the October expiration, right? It's this 2250 option. Let's see, how do I do this? Okay, if I click there, then I can see the Greeks down here. So this number is probably the most important number. There's theta and vega are also pretty important. But delta tells you how much the value of your option will increase or decrease with a $1 increase or decrease in the underlying stock price, right? So it's saying with a delta of 53, ignore this kind of decimal. So this is just a 53 delta, let's say. So with a 53 delta, it's supposed to be a D, then if the stock goes up $1, then the value of option should go up approximately $53. Okay? Now, this is the same thing as saying you basically own the movement, the upside and downside of approximately 53 shares, right? So it's the same exposure of having about 53 shares. So that's what delta tells you. Is kind of how many shares of exposure do you have here? That's 53. Now, delta is a dynamic number, so the deeper in the money your option goes, because the stock price is increasing, then the higher your delta will go. As the stock price drops, your delta will go down. So embedded in a call option, it's kind of like this machine that's working for you, where it will buy up more shares. You'll increase your delta, effectively giving you more and more exposure the more your stock goes up, which is nice, right? So the more the stock goes up, the faster you make money. Conversely, as the stock price drops, delta will drop. And so this machine kind of is automatically, it's as if the machine was selling shares on the way down so that you're reducing your exposure and losing less and less the more the stock goes down, which is nice, right? So you'd like those two characteristics. That's why I love options. Just straight up call option. A lot of times it can be a good move, especially when implied volatility is low. Now, implied volatility for Discovery here, 50%. It's at about the 40th or 50th percentile. So it's not the cheapest right now. But I went ahead and I went out to October, and gives me a long, almost 6 months of time for this to move, right? Okay, so that's the first thing, and all of you know that, so I'm not necessarily planning to hold this till expiration, but it gives me that 53 shares of exposure for the time being, right? I'm going to see where this goes in the next 2-3 months, and then we'll probably roll it out. And I never like to keep options where it has less than 3 months till expiration, because then time decay just eats at that. All right, that's a longer explanation than all I want to give on this straight up call. So that's number one, is just trade number one is just a call, right? So one other thing, sorry, I wanted to mention about this trade with this 2250 call, right, for $250. So you're spending, I actually think that price is actually inflated a little bit at the end of the day. So you could probably get it for $230 tomorrow morning, whatever. Let's say you bought it at $230. Now we said you got 53 shares of exposure, right? So how much, I got to pull out my calculator. So how much are we effectively paying for each share, right? So that comes out to be about $4. So we're taking $230 divided by 53 shares, right? So we're paying about $4.34, 34 cents for that. Okay, you guys can't read my handwriting, I'm sure. So you can see you're buying at a substantial discount effectively from the current stock price. I just wanted to show you that really quick. So you can kind of do that mental math whenever you're buying on options. Like, okay, how much am I actually buying these shares for effectively? Because I'm getting that same exposure. Now, there are risks to options, right? And there's another time, another day we can explain that, time decay, volatility risk, and all that. But generally, that's delta's the most important number, and you can get, the exposure you want by picking the right strike. So the second way that I would play or invest in Discovery is, which is a more conservative way in my opinion, is to do a call debit spread. So a call spread, let's hop over to the July expirations. So this will be a little bit quicker, but with call spreads, I think you can move closer in time because you are negating some of the theta, which I'll explain in just a minute, the decay, the time decay risk. So what I would do is with a spread, you buy one option and you sell another. So I would buy this $20 call, and then I would simultaneously sell the 25. So I sell this for $243. I buy that for $243, and I sell this for $40. So if I go here, it shows me that my total debit is $203, right? Now, what we can do is try and figure out our delta for this spread. So how much the value of our option spread will increase for every $1 increase in the underlying stock price. So if I click this 20, click there. So this has got a delta of 75, right? Right there. Okay, remember that. And then I come back and I click on, it's so much easier in the TD Ameritrade app, and I know a lot of you use Robinhood, so that's why I'm using Robinhood on this video. I wish they would make this a little bit more user-friendly to figure out. Then you can see here, delta's 22 on that one, right? Okay, remember those numbers, 75 and 22. So let me go back here. All right, so remember I'm selling that one. I'm buying this one, right? So I have 75 delta on one, and then I got to subtract the 22 delta because I'm selling this $25 call, right, which has 22 delta. So I got to subtract that. So my net delta, let's see if I can still do this math stuff. Oh, look at that. 53, just like our other option. I did not plan this, by the way, just so you know. There's just total happenstance there, which is pretty cool. It's meant to be. So 53. So this trade will give us also the equivalent movement of about 53 shares, right? The equivalent exposure. And for that, we said we were paying about $203. Right? You always got to multiply by 100 with options. So you can see there. Yep. So $202.50, about $203 if you want to put this spread on. Now, the nice thing is this trade breaks even at if you do the math, $22 and 3 cents. So at 22.03, let's write that down. The break even is 22.03 on this trade. So if by that July expiration, your stock is trading at 22.03 or above, you will not lose money. That's an E right here, by the way. But if it's trading below, then you will lose some money. But you can always sell it before you get to expiration if you have a nice profit, or if you want to avoid loss. If you feel like it's going down, you can sell it early. But the max gain on this, so the distance between the 25 and the 20 strike is $5, right? So you multiply that by 100 because an option contract is 400 shares. So your max gain is on this spread is going to be $500. So on any spread, the max gain is the distance between the two strikes multiplied by 100. So if you spent $2.03, right? So 500 minus your $203 that you paid for this spread. So you could make a maximum of $297 profit, which is more than 100% gain, right? So you could have more than 100% gain if by July, I forget what that was, July 17th, the stock is trading above $25, right? If it's trading at $24, this spread will be worth $400. If it's trading at $23, this spread will be worth $300. So you can have a nice, decent gain. You're risking $200 for it. Basically, if the stock stays exactly where it is now, you essentially don't lose money. But if it moves up a little bit, you can more than double your money. So that's the cool thing about spreads as well. Compared to the first trade, this is capped potential, right? The most you can make is 500. The other one, in theory, you could go to infinity, but let's say the stock popped to $30, $35 before that October expiration. Then, for example, at $32.50, that one would be worth $1,000, right? So that's the difference there between the two trades. Hope you enjoyed this. If you have questions, feel free to ask them in the comments. If you have comments, feel free to ask them in the comments. And I'll just try and continue to find what I think are good deals in the market and present them to you and let you know how I would play them. Full disclosure, I am long Discovery, right? And none of this should be taken as investment advice. My channel is geared toward educating you, not so much in giving you specific advice, right? I am not giving you financial advice, but I hope that you can learn how to use options to your benefit, and I think it will definitely have potential to bless your life if you use it wisely and appropriately.